Today, folks, we just witnessed the first Canadian bank to post earnings, and of course, it's the most controversial, being Toronto Dominion. The money laundering charges, the asset capping in the United States. Still, between all that restructuring mess, the stock was able to rally 3% today, up 22%. I told you guys when this thing was yielding over 5%, it was quite an intriguing buying opportunity, and really reminds me of kind of where TELUS is at. We've seen a lot of the mega cap companies in Canada go through these restructuring periods after the interest rate cycle, though Toronto Dominion is dealing with a whole new onslaught of problems and is still kind of getting through it, because right now they have the most resilient balance sheet. And we're going to need to talk about this because I'm sure you've seen the headlines that basically Toronto Dominion is laying off 2% of their workforce, probably all in relation to what's going on in the United States. But they do have quite a resilient balance sheet to ride through this, and investors are recognizing it. And I'm always paying attention to these earnings because they're some of the biggest weightings in my Canadian dividend ETF, my monthly paying dividend ETF, VDY, till I'm motherfucking die. I love this ETF as it's now up 2.77%. And if you tap on the 4% yield, it looks like we're going to be getting some pretty reasonable returns as this repels back to all-time highs and even outpaces the S&P 500 this year. But you can see Toronto Dominion Bank makes up a 9.48% weighting. And if you live in Canada, if you invest in Canada, regardless of what you're buying, it's likely you have exposure to Toronto Dominion. And yeah, these are going to be the defining factors to where this ETF goes, because most of its exposure is to these banks. Now, if you looked at the earnings, I was a little confused by what was posted on the Google earnings and what was reported and what I saw on Twitter and stuff. But when I moved over to the actual balance sheet, it was showing something quite different. And that's because they recently sold their entire stake in Charles Schwab, from my understanding, because you can see they actually beat earnings by 10%, revenue by 12%, up to $15.14 billion. But as we read into this, we can see that their earnings per share were actually $6.27, which I was kind of confused by because it said it was reported at $1.97. And this is nothing to do with the revenue or actual earnings. It's just because they added that massive sale value to their bottom line. And that sale is what is bolstering their entire balance sheet, because you can see they have a gain on the Charles Schwab shares of $8.97 billion. It added $4.92 per share, bolstering the earnings that we're currently seeing here. And if you just take a look, they're utilizing those earnings right now. We're not really hearing too much of a major like one-time dividend expense or anything like that. Seems like they're just keeping this cash to bolster themselves and continue doing their share buyback program, which they've already bought over 1% of the outstanding shares this year already. So that's something really nice to see. And the revenues are still, again, going up into the right. Like, they're still stabilizing and continuing to go up quarter over quarter, surprisingly, but we are still seeing loan loss provisions carry a bit higher, which again is something I don't like to see and is still a huge factor to bolstering the bottom line of this business. But I think they have the capability, with over $2 trillion in assets right now, to get through all the problems they're experiencing, because Canada should still be a good growth vector for them. Even with the restructuring in the States, they should still be able to get through it. And, it's funny with all this $22 million from that one-time sale, it makes it look like their dividend payout ratio has dropped dramatically here. I mean, if you take a look, their price to earnings ratio is 9.1. The payout ratio has dropped down to 16. All of this is going to have to readjust in the next quarter, so don't take it too literally. But here, if you take a look at the common share information, this is where you can see that other data is being pulled from, with a more accurate payout ratio of 53%. So if you just scroll down, you can see where the more accurate, not the one-time, capital gain was added to the balance sheet. But again, when you kind of go through the performance, this is great. And I'm going to break this down into some segments here to give you guys a more clear image. First and foremost, the U.S. Balance sheet restructuring. They're having to do a 10% asset reduction. Loans reduced by $11 billion in Q2 of 2025. They completed the sale of $9 billion correspondent loans. I think all of this has to do with the court orders. They paid down $4 billion of borrowing using mainly proceeds from loan sales and investment maturities in Q2 of 2025. Between May 1st through May 21st, they paid down an additional $7 billion in borrowing. These guys have been hard at work, man. And it's funny because when it comes to this whole idea of money laundering, all the banks are dealing with this. It's not just TD. It's just TD got caught, right? Like, you have to imagine that regardless of where you live in the world, to some extent, people are laundering money. But I think it was something like $400 million was caught. So they got busted with it, regardless of how it made its way into the bank. They're the ones that are having to deal with it. But if we scroll through the growth by segments here, you can see the Canadian and personal commercial banking net income was down 4% year over year. And this is the highlight of the worst, I think, of what we're going to see here. Canadian banking is just not a great place place to be right now because the expenses were up year over year. The net income was down, but revenue was up 3%. So that's not like the worst thing. But when you actually go into US retail, because of the continued momentum and progress on the balance sheet restructuring, the net income was down 77%, revenues were down 28%. It just looks more and more abysmal the more you look at it. But then you get into wealth management and insurance. This was up 14% and revenue was up 12%. Not that bad. Wholesale banking, net income up 16%, revenue up 10%. So regardless of how you feel with what's going on with this bank, there's still a lot of resilience in the market, especially with wealth management, wholesale banking, and some of these things that should bleed over and give some bullish sentiment to the other banks, especially with Royal Bank. They've done some major acquisitions like the HSBC stuff. So they should still see a bolstering, right? Like I think bank earnings as usual will be a bit mixed to who's performing the best, but these mega banks, I mean, it's crazy, especially after seeing like JP Morgan's earnings in some of the US banks and how fast they were growing. It was quite impressive. But if we take a look at those loan losses, this is the only real concern to me. And, you know, there's a lot of complicated issues this bank's dealing with. I wouldn't be able to break it down professionally or properly. I do suggest actually go watch this video here if you want a bit more in-depth knowledge from BNN. They did a great job. But I'm always just looking at the loan losses because I'm waiting for the day this stabilizes. Now, it's not out of control. It's not in a place of major concern, but since the pandemic, this has gone up quite materially from where we sit now. I mean, you got to remember the pandemic was 5 years ago, and we're still seeing a trickling up in loan loss provisions just from the aftermath of the interest rate cycle. So I'm looking forward to the day that this comes to an end as interest rates come down and things start to nominalize, but that's more to look forward to in the future, presuming we don't end up in a full-blown recession. But honestly, when you look at the markets, earnings that we've seen so far from the mega cap companies, I don't think anyone's really complaining, and we're seeing it kind of show up in these stock prices, right? I mean, all of the broader Canadian markets have outpaced the US. And when you look at TD, man, starting to recover, whoever bought the dip, I will give you an applaud. You locked in a great yield, a yield that is still likely to grow into the future, and a company that can prove it can get through extreme troubles just like this. Kind of reminds me of Wells Fargo. They went through some extreme volatility to something in relation where their stock dropped miserably on some, I think they were setting up like multiple bank accounts for promotions and stuff, and it was like illegal. All these banks go through cyclical cycles like this, but they seem to be doing pretty well. So I'll pass the question off to you. I'd love to know what you think in that comment section below.